Connect London is brought to you by Lendlease, JLL, and is powered by Unisu. Dharmesh Mistry highlights what PropTech can learn from FinTech.
My name is Dharmesh Mistry and I'm a FinTech entrepreneur and PropTech investor. What I'd like to share with you today is some of the lessons I've learned from 30 years in digitising banks and how that might be applicable to the PropTech and real estate markets. For me, it's clear that the banking industry has heavily invested in technology and has probably been a front runner in the use of technology across most markets. However, I think it's an exciting time for PropTech, and there are many lessons to be learned by not being first to market with some of the technologies. I'm going to share with you some of those things that I've learned out of banking that you could use in the PropTech side of things. But first, I'm going to give you a bit of background on myself. I started my career in Lloyds Bank in the late 80s and was involved in the rollout of 40,000 PCs for the very first time across the branch network. The goal of the project was fairly simple. It was to reduce the number of people and the cost of running branches. However, the bank expanded and we hired ever more people, and actually the cost went up. In '93, I was involved in a project called Business Process Reengineering. And this was really when companies for the very first time started to talk about the concept of a paperless office. And our goal was simple again. It was to reduce the amount of paper that we used and to reduce the time spent on processes. However, as the bank expanded, we bought more printers, which meant we spent more on paper, and actually we implemented more processes. I guess what we learned out of that really was that we just got better at documenting our processes and putting them onto paper. In '95, I moved to NatWest, and here they had already been trialling Mondex, which is a digital cash project. And needless to say, about 18 months later, we canned the project because actually we weren't seeing any real customer adoption. It was too early for its time. In the late 90s, I moved to my very first FinTech. And here I launched some of the very first internet banks across Europe. At that time, the industry analysts were forecasting the end of branches and that they would lose market share to pure internet banks. Needless to say, as we know, that didn't happen either. And in 1999, I launched the UK's first mobile banking project for Barclays. And even then, back in '99, analysts were saying that mobile banking would overtake the internet. Now, at that time, the mobile internet experience was very poor because of bad screens, because of poor memory and processing capabilities, and that project fell too. So, in terms of lessons learnt, from my experience, I think you can take away three things. Firstly, for all of the hype about technology and change occurring fast and needing to respond quickly, you must remember that actual customer adoption is much slower than most of us realise. For example, internet banking has taken most banks more than 15 years before half of their customers were using it on a regular basis. And the same timescale, 15 years for mobile banking to hit more than 50% of their customer base. Secondly, even though we set out tangible goals to meet or justify the expense that we have for starting a project, there are other goals that are probably more important when it comes to new technology, like understanding the skills or the maturity of the technology or how that technology can be fully exploited. So those are still important, even though we might not reach the outlying investment goals. The third thing is that given that I've told you that pretty much everything in the early part of my career failed, you could deduce that let's move on from that. Next, I'd like to talk about the drivers for change. In my 30 years of banking, I've never seen so many drivers for change that apply pretty much globally and across all sectors. Yet when you look at the detail behind these drivers, they mostly could apply to actually any industry. I highlighted two areas here on the deck that you can see that you might think are banking specific, but they're actually not. I think if you look at the competitive landscape, for example, the real estate market could be disrupted by FinTechs as well as by PropTechs. Big tech players are a threat in property too. As you know, both Amazon and Facebook have already been looking at how they can take part in the property sales side of things. And although regulation like PSD2 and open banking are targeting banks, that's true, but it's non-banks that are set to benefit the most. I'll evidence this later as there are already some PropTechs leveraging open banking. However, in terms of the drivers, it's really technology that's creating the most change. And the challenge there is that there's so much to look at. We start with blockchain, artificial intelligence, chatbots, platforms, cloud. The list seems never ending. And it feels like the list is growing daily. At least this is my observation as the Chief Digital Officer for a billion-dollar banking software company. It used to be that technology had one single leader and it was their sole responsibility to understand and manage and decide what technologies to use. Now it would be remiss for any company to think that way. Starting from the board down, everyone needs to appreciate technology and how it can shape business going forward. So, when looking at the strategic picture, the lessons I can share are firstly that most of the change drivers are the same across industries and that digital is a global cross-vertical phenomenon. This cross-industry observation is key. Today, in the short term, it may mean that when you're looking to hire new people, going outside of the property industry will give you a bigger pond to fish in. But longer term, we see that industries are probably going to start to merge. And VCs are already investing in what's called the real estate FinTechs. This is where real estate and financial services start to meet. Finally, technology must be seen as a core competence for the entire company. I'd go as far as to say that for most basic jobs, that an understanding of technology is more important than learning maths. You may think that, well, actually, Dharmesh can say that well because banking is information-centric. Property focuses on bricks and mortar. However, there's a huge volume and variety of data in property, much of which has yet to be digitized, let alone exploited. And one of the reasons I'm now focusing on PropTech is because I feel that there is a huge opportunity that's totally untapped, given the right application of technology. A question I get asked quite often is, what is the difference between digitized and digital? And, I've sat in, boardrooms with senior execs of listed companies who are explaining their strategy to me about how they're becoming digital. And actually what they're really doing underneath the skin is digitizing. They really don't see the difference between the two. Well, let me explain. A traditional organization makes products to sell. But in the digital world, we've seen companies like Airbnb and Uber that don't have assets or products to sell. In the digitized world, you can't operate without people. In the digital world, you can't operate without the internet. One is focused on efficiency and renovation. The other is focused on hypergrowth and reinventing businesses. Perhaps the biggest difference is that digital organizations are focused around the customer and organized around the customer, whereas traditional organizations that are digitizing are typically siloed around products. So essentially, being pure digital means that you design the company without these 5 Ps: people, process, paper, premises, and physical money. You then add them back in where absolutely necessary, or where one of those 5 Ps can add some real value. For example, in some countries, Uber still allows the driver to take cash. Uber clearly has all of the above 5 Ps, but they do a great job of hiding them from the customer experience. Hence, they are the poster child for frictionless journeys. And this is something I think every PropTech or property company can take heed from. In essence, being digital looks like a driverless cab, fully automated by data and personalized for customers' individual needs. Has anyone ever met anyone from Uber or from Airbnb? Unlikely, and that's because they've actually been designed to be pure digital. So, in the property sector, so far as I'm seeing, I'm not really seeing the level of investment that I've seen in the banking world. However, even with some investment, some banks are still struggling to define the difference between digital and digitizing. And here I think, property companies can save themselves a lot of money by really focusing on what they really want to achieve. It tends to be that incumbents digitize while startups reinvent business models. And that's certainly true in banking, and so far in my experience, also in PropTech. The key challenge for incumbents is that they would have to cannibalize their existing business models to be truly digital. However, can you see Zoopla or Rightmove moving to a freemium model, for example? No, nor can I. For similar reasons, this is why Blockbuster and Kodak failed as businesses. The last point applies to any industry, as we've already seen with Uber and with Airbnb in PropTech. We're seeing players looking down, taking out friction in the buy-sell process. However, I believe there's much more that can be done in other areas of PropTech, like property development, like development finance companies, and also household property management. Banking is like most businesses. On the one side, we have customers, and on the other side, we have to create products. And in the banking world, that's deposits, loans, mortgages. Banks can innovate both the customer experience as well as the product definitions. I'll talk about the impact of open banking shortly, but it's important to understand why regulators are driving the initiative, as it's likely to open up open data initiatives in other industries, especially areas like property or even things like utilities. Essentially, banking was a market whose growth had slowed to a single-digit percentage. This allowed the bigger players to dominate and stifle competition, and this in turn meant that customers had little choice, essentially being held to ransom by the big banks. Open banking, and specifically PSD2, was created to drive innovation and to create more choice for customers. The impact of this was the creation of new business models, ecosystems, and new segmentation models, which I'll explore next. Traditional banks manufacture and distribute their products. However, open banking has helped to create 3 new business models. Pure manufacturers. These players will create and manage bank products for other banks, otherwise known as banking as a service. The players in this space will compete on scale, efficiency, and reach. Pure distributors. These players focus on direct relationships with end customers and compete on customer intimacy. Since open banking, we've seen over 200 new players in this category. The third is a pure platform play, providing services to banks and FinTechs, for example, things like credit scoring or KYC checks, provisioned out of the cloud. All of these models are importantly facilitated by APIs. However, banks can, as you can see, operate in more than one of these models and have created hybrid models. For example, Starling Bank have a couple of their own products, but a broader marketplace of third-party offerings. Fidel Bank provides a platform for other banks to run their products, but also operates as its own independent bank. It's fair to say, in terms of creating innovation and choice for customers, open banking has succeeded. The use of open banking, however, is not limited to banks, and I believe the benefits and changes driven by open data will apply to other industries, and especially in property. One question that's often asked is, what about the big tech? Will Amazon and Facebook and Apple get into banking? Well, the answer is they have already entered banking, but as distributors. And so the real question is, why distribution? It's not strictly because of the complexity of regulation, although that is a hurdle. It's really about the numbers. Most of the profit comes from distribution, whilst the volume of revenue comes from manufacturing. So distribution is a very attractive player for any competitor. And it's certainly an area that I think the PropTechs should start to exploit. And some of them are already starting to extract some value out of open banking. There's players like Hammock that allow you to do things that banks don't provide you with. For example, a bank won't tell you when a renter hasn't paid their rent on time, but Hammock will notify you. StuRent and Credit Ladder both use open banking to manage student risk and to provide credit history for renters that couldn't get access to loans before. These are great examples of PropTechs leveraging open banking, and I know that there are going to be many more to come. So, The key things to take away from this is that although customers will need access to accounts, loans, etc., how they get them is changing, and they no longer need to go to a traditional bank for them. I've written extensively about experience-driven banks, and essentially banks that provide a set of value-added services on top of banking and derive new revenue streams, thereby competing with traditional banks, but on very different terms. We have seen how Uber and Airbnb have disrupted markets. We're going to see this in every market, and especially in a data-rich industry like property. If you haven't read Platform Revolution, I strongly urge you to do so, as new platforms will compete quickly with established players. For example, even the likes of Rightmove and Zoopla risk being disrupted by new players. Personally, what I've learned that it's not change that we have to worry about individually or as individuals, but developing our ability to constantly learn is what's really important, I think, now to kind of thrive in the future. Finally, I'm going to leave you with what I'm asked most often after conferences. Yeah, that's what's the future. We don't really have time to kind of go through that in detail, but please feel free to follow up with me on Twitter. And, I really appreciate your time listening to me today and would love your feedback and any other questions on my Twitter handle. Thank you so much.